So calendar spreads did not react in a big way. The high terminal prices did trigger another production, though, and certs recovered, fluctuating between 1.3 and 2.3 million bags over the next 9 years. During this period, there was also an important change in the ICE Arabica contract, because in 2013, they allowed washed Brazils as a tenderable quality, which ultimately shifted the contract from being a milds contract to a semi-washed Brazil contract. Finally, we come to the present era of inversions, which begins with the frost of July 2021. The weather event drew down inventory, and spreads rallied accordingly. Low certified stock levels created significant positive S&D factor premiums, which overwhelmed the costs in the market structure and inverted the market. In fact, the inversion would actually be a couple cents higher, but the present high interest rate environment is actually offsetting the S&D factor at this point and pulling the calendar spread inversion lower than it otherwise would be. So what are the key lessons from our analysis? First, weather shocks are primary catalysts for calendar spread inversions. All of the major and minor inversions of the last 40 years were triggered by weather shocks. Second, the relationship between spreads and certs is not linear. Instead, there is a binary dynamic of abundant or scarce certified inventory. Either they are above a certain threshold, which appears to be about 1 million bags and indicates abundance, or below that threshold, which indicates scarcity. When in abundance, the calendar spread stays in contango with an S&D factor of about minus 1.2 cents, or the stocks are below that threshold and invert with a high correlation to certified inventory. So during the period of scarcity, the calendar spreads will invert exponentially to protect certified inventory from going to zero. When in abundance, the calendar spread stays in contango with an S&D factor, the controlled market period, the first cert draw, and the second cert draw are our 3 examples of sustained inversions. All 3 were instigated by weather shocks, and both the 94 and 21 cert draws were highly correlated with certified inventory levels. We can use this relationship to create our price model. The blue line represents the forecast model price based on certified inventory levels, and the orange line represents the actual calendar spread price. Since we are in an environment of scarcity with low stocks, we can use a forecast of the certified inventory to predict what the spreads will be with relatively high confidence. Now, looking forward, we can make some predictions. On a longer time frame, we can assume that the prolonged state of high prices will incentivize production and bring in another period of abundant stocks. In the past, prolonged periods of 150 cents and above have drawn in new certs. If the stocks can be raised above 1 million bags, these abundant stocks would pull the market back into a contango market structure. It's hard to say when this will begin. However, the 26-27 crop in Brazil seems likely if the 25-26 crop disappoints as expected. The present high interest rate environment is forecasted to decline to a more modest 2.5% over the next few years, which will retain some small opportunity cost in the tangible cost baseline. Now, the warehousing costs I don't have direct access to, but anecdotally, I have been told that coffee holders in destination are under high competition for warehouse space from companies like Amazon and Walmart, so we could see the warehouse costs remain relatively high. In the short term, we are in a period of scarcity, and so the certified inventory will have a direct impact on the extent of the market inversion and its eventual termination. So the good news is that our model does a halfway decent job of predicting calendar spreads based on the certified inventory levels. The bad news is that predicting certs is not so easy. The general rule for whether coffees will be submitted to the exchange for certification is that when coffees can be bought below the cost of certifying, shipping, and delivering profitably to the exchange we'll see prices rise. We'll see certs rise. The calculation for profitability is called tenderable parity, which is the break-even cost for selling coffee to the board. Since 2020, Brazil has been the default origin delivered to the exchange. Therefore, we can look at the ICO Brazil natural prices as a rough proxy to tenderable parity to try and predict cert levels. We had 3 periods of increases over the last 4 years in certified inventory that correspond to periods with diffs below 0. There was one 2-month period in 2024, one 2-month period in 2022, each with a gain of about 400,000 bags of certified inventory. There was also another 12-month period in 2020 that drew in about 1 million bags. So it stands to reason that if the diffs by this metric fall below 0, certs will rise. So when will diffs fall below 0 again? For diffs to fall below 0, we need one of 2 things. We either need a major rally or another large crop in Brazil. I think the 26-27 crop is the most likely candidate for cheap Brazils. I don't want to write off the 25-26 crop entirely yet, but initial assessments are mixed at best. It is possible that the crop will surprise and be much better than expected, but personally, at the Coffee Trading Academy, we will not have a better idea on the size of this crop until we do our Brazil Farmer Survey in December. Whoops. How'd that get there? It's also possible that the futures market rallies enough. It could compress differentials enough to be tenderable. Both of these scenarios are possible and could draw in certs sufficiently to bring the market back into carry. I don't believe that these are the most likely scenarios, but stranger things have happened. All right, now's my joke. Too soon? Okay. Finally, we have to consider whether certs will draw more before then. I think it's plausible that they resume their decline, as this has been sort of the default in periods of high differentials. So, as we are in a tight stocks scenario now, any cert draw over the next year will likely see front-month spreads rally in a highly correlated and exponential fashion. We think that there is a strong possibility that this happens at some point in the first half of 2025, before the next Brazil crop. If certs do not draw, but instead remain flat, then spreads will likely remain inverted, but not necessarily rallying beyond current levels. There is some room for optimism, though, if you're looking for a return to contango. Our study of history shows that inversions in high prices tend to invoke structural shifts in supply that push the market back into contango. The current environment of persistent high prices is likely incentivizing farmers right now to take better care of their crops and to increase planted area. This could be setting the stage for a period of abundance and cert growth, much like we saw in the aftermath of previous rallies. So in conclusion, our model and study of history provides some context for our present backwardated environment. The model suggests that spreads will be highly reactive to certs as long as they are below 1 million bags. We think that it is very possible that we see another cert drawdown in the next 6 months, which would rally calendar spreads. However, we seem closer to the end of this inversion than to the beginning. Ultimately, in coffee, both the flat price and calendar spread structure are self-correcting. These prices ration supply and demand by pushing and pulling forwards and backwards in time. While we're in the moment, a 3-year inversion feels like a very long time. However, this time frame is not that dissimilar to the 94 to 99 inversion. We have to remember that the coffee market is not on our time frame, but rather on the time frame of the coffee tree. Coffee trees have a 2 to 3 year lead time in production, so it will take at least this long to react to supply stocks. Ultimately, the old saying goes that the cure for high prices is high prices. Our current environment of high prices and inversion now is laying the groundwork for a flow of longer-term supply that will restore inventory levels and return the market to its equilibrium of contango. That is until the next weather shock. Thank you. Appreciate your attention. We do have a little bit of time for questions if you have one. All right. Okay. Questions will be sent via the app, apparently. Thank you.